Thing number five, Gary, as we've continued to move forward in our investor research education piece, we've got another great question that we're coming in for our fifth thing. We're talking active versus passive investing. Gary, thing number five, tell our viewers out there, what is the difference between active and passive investing?
So, Rob, this is a question that came in from, one of our younger, inexperienced readers, and it's a really good question. So, as somebody who grew up in the hedge fund business and was a portfolio manager and ran funds, I was always an active investor. It meant that in my case, I was running a relatively concentrated portfolio where I was selecting individual names and picking the exposures that I wanted. And, at times actively trading things, other times I would, hold for longer. But there's an art to it and a lot of work, and it's very difficult. The advantage is that if you get it right, you have phenomenal returns. And at Deep Knowledge Investing, one of the things we've talked about is we have had in 5 years more stock picks that have gone up 100% or more than we've had picks where we've lost money. So, you do that and you can beat the market. Now, the downside of active investing is things might not go well and you could have some bad picks. And by the way, we all have, I don't know a single portfolio manager, we've all gotten things wrong and sometimes badly. And when that happens, you can trail the market and that frustrates people. People don't like losing money, but they really don't like being down more than the market is. And, that can be a challenge. Passive investing, those are people who are buying mutual funds or exchange traded funds, or typically index funds. They might buy SPY or QQQ for the S&P 500 or the NASDAQ 100. And those exposures are set. And so if you buy those, your return is going to be the market return, less typically small amounts of fees. Now, some of these funds have a bad fee structure, but a lot of them have very low fees. The advantage of it is you don't have to do what I do, which is work 15 hours a day looking for great ideas and doing research. You just, it's like set it and forget it. You buy it, you're going to own the market return, and you pretty much leave it alone. The downside is you don't really have control over your exposures. And the way these things work is they tend to be market cap weighted. And the reason that's important is because as a company becomes more overvalued and larger, it takes up more space in the index. And so you're constantly, if you're passive investing, which is indexing, what you're doing is you're increasing your exposure to the most overvalued names and decreasing your exposure to the most undervalued names. And that's what happens over time. And that's the risk of that. And so, my view on this is like everything else, both strategies, active and passive, have benefits and detriments, and you need to know what's right for you. And if you're a professional investor like me or my peers, we like active investing, and that's the direction we want to go. But for somebody who isn't doing this all day, passive investing could be a good option for you. Again, you could be okay either way. You just need to know what your goals are and what your core competency is.
Gary, as someone that is not a professional investor, how much do taxes play into active versus passive investing? Because as someone that is a novice, like, are there certain tax implications that active traders need to be more aware of than passive traders?
Well, you have more control if you're an active investor than a passive investor. So let me give you an example. Let's imagine, that you're a passive investor. You own an exchange traded fund, or, you own a mutual fund, something like that. If they have gains throughout the year, which is not a bad problem to have, you get the tax bill even if you haven't recognized that gain. And so you could be in a situation where you're invested in one of these funds. You don't sell anything. You don't have more cash, but you get a tax bill. And you put that in, you fill it out when you fill out your 1040 form with the IRS in April. And when that happens, you're going to be paying out of your pocket. And, people may not like that. The advantage of active investing is while it doesn't enable you to not pay taxes, it does give you a little more control. So, let me give you a couple examples. Uh, One would be that long-term capital gains taxes are much lower than short-term capital gains taxes. Now, there are exceptions, and I'm not a tax advisor, but in general, that's how these things tend to work. Well, the difference between long-term and short-term is 1 year. Let's say you own something you'd like to sell and it's up a lot and you have a lot of gains and you've owned it for 360 days. You might hold that thing for another 5 days, get long-term tax treatment, sell it, and reduce your tax bill. I'll give you another example. Let's say, this year, 2024, we've had a good year. We have a lot of gains. We're, going to be in a high tax bracket. And, it's late December. You're looking at selling something else and recognizing gains, but you're going to pay a lot of taxes on it. You might delay by a week or two and sell it in January and not recognize as much in capital gains this year and have some for next year. One other example, let's say, we're rolling into the end of 2024 and you've had a good year, you have a lot of capital gains. So terrific, good for you. But, say you have a position on your sheets where you have an unrealized loss. You have the option before year end to realize that loss, to sell that position, take the loss, and reduce your tax hit. So with active investing, it doesn't allow you to avoid paying taxes, but it does give you more control over when you realize those gains or losses, the way that you do it, whether you do it in this year or the next year, how you offset them against each other. And, whether you can hold on for a little longer and get long-term capital gains treatment, which is, again, I'm not a tax advisor, but that tends to be more tax efficient. So, these are things that, is it hard to manage all that? No, but you do need to know something about tax, accounting, portfolio management. It's something you need to think about and keep track of. And, these are things that as a portfolio manager, I do. And, I don't think if you're listening to this, it is not beyond you to do this, but it also doesn't take care of itself. It's another thing that you have to do. But if you're willing to do it, you have more control. You know what it's like, Rob? It's the difference between driving a car with an automatic transmission and a manual transmission, right? The manual transmission is more challenging to drive. You can't tune out. You have to have both feet and both hands engaged, but you have more control over the vehicle. That's the best analogy I can come up with for that.
Awesome. Love it, Gary. Great analogy. And thanks for that. Thanks for clearing that up. That will conclude this week's version of the 5 things. Again, this was the Bond Bears issue. As always, be sure to subscribe to where you can get the 5 things directly in your inbox each and every week. And Gary and I will continue to keep the pulse on the markets and bringing you the most important things to know for any given week. Gary, any closing thoughts before we sign?
Yeah, I want to thank Michael Guyot again for having me on the Lead Lag Report. Always appreciate when he brings me in for his show. Great talking with him. Thanks also to Amy Nixon, Texas Runner DFW, I think.
Yes.
For the fun exchange on Starbucks. She's worth following as well. Round of applause as usual to Andrew Brown and Alex Petro, the great DKI interns who were very fun and funny this week. Great work by both of them as always. And Rob, I know you're traveling, you're at this fantastic conference, and as always, you make time. And for the people watching this, thank you so much. We know your time is valuable. We appreciate you spending it with us. If you want to like, comment, subscribe, we'd be happy to have you more involved. And also for the people who, there was a Bitcoin segment we did last week that ended up getting a lot of attention and a lot more likes than usual, a lot more comments. For the people who chose to engage, thanks. We really appreciate you. And thanks for being part of Deep Knowledge Investing.
Thanks.